Welcome to Catalyst. I'm Madison Mills, 30 minutes into your trading day. Let's get you the 3 catalysts that we're watching this hour. First up, we push ahead to the all-important Fed decision today and what the central bank has to say about the market's growth concerns. Plus, we track the tech trade as all Magnificent Seven members drop into the red this year. Could a rebound be on the horizon? We'll discuss. And we'll talk about navigating geopolitical volatility as tensions rise between Russia and Ukraine. What risk does it pose to the market? All this and more ahead. Half an hour into the start of your trading day, let's get you a check on the markets, brought to you by Tasty Trade. Taking a look at the major averages, I have some green to show you today. You've got your S&P 500 up about 0.6%. Your tech-heavy NASDAQ taking the majority of the gains here, up about 0.8%. When you take a look at the sector action in your S&P, it is the tech names that are the biggest drivers of growth today. If that can continue, how much recovery will we see? Of course, the key Fed meeting at 2 p.m. is going to determine a lot of today's trade. But let's flip the board over to the bond market. Here you've got your 10-year yield hovering just above that key 430 level, moving to the upside just a bit this morning as you continue to see that sell-off happening just a touch here. And you've got the longer end of the curve moving to the upside still as well. But let's get to our favorite risk-on, risk-off indicator here. We've got Bitcoin moving to the upside, up about 3% this morning, hovering above 84,000. I want to welcome in Jessica Inskip, the Director of Investor Research at stockbrokers.com. She's going to join me for the hour as our guest host. And Jessica, it's amazing to have you. Thank you so much
for
coming up and making the time. One of the things that we've been talking about is whether or not the market can recover without the Mag 7, given how much weight they have in the broader index. Is the AI trade going to help us with the market recovery right now?
I think it needs to participate, and I think it can help us. We had this big event with NVIDIA yesterday. We're seeing some come back today. However, for some reason, the market hasn't been focusing so much on the AI narrative and is really focused on this uncertainty. Uncertainty causes volatility because we don't know what's going to happen. Uncertainty translates into businesses and consumers. We're seeing in economic data. And then uncertainty even with what the Fed's going to do today. So I think we need the Magnificent Seven. We need that AI narrative, but maybe we'll see that translate over once we get past this uncertainty and get some answers from the Fed and even some trade policy talks with what's due on April 2nd as well.
So it sounds like there's not a ton that's in control of these tech firms in terms of making sure their stock prices recover. It seems like it's much more the macro, both in terms of the Fed and the White House.
That seems like what the market is focusing on, where the earnings were still really, really great for all of those AI stocks. They consistently beat their spending on CapEx, but they did that before in 2022 when we saw this turnover. We have seen CapEx spending consistently, so I don't understand why that's the big issue if they're still consistently beating earnings as well. Now we've got really compelling valuations, so the question is, if we get some certainty from the Fed today, we get some more certainty with the market, are buyers going to come in and swoop in and make that AI narrative come on? With seeing Bitcoin risk on, that's an early indication that perhaps that will happen, but I still think we're early on the AI revolution and the AI for everything. There is so much that's happening that applies to every single vertical, every vertical.
Yeah, well, I also want to give you a chance to talk about the Fed because obviously it's Super Bowl day. We've got a Fed meeting today.
It is.
How are you thinking about the Fed? What are you going to be listening in on from Fed Chair Powell?
So I think tone is going to be extremely important. Powell right now, he actually at the Boston Economic Forum about 2 weeks ago, he said that the cost to be cautious is really, really low. And like we were discussing before the show, is he going to be too late? Is he going to lose this window where he's not going to cut quick enough? And that's what worries me. I don't think he's going to do that today, but what I'm listening for is his tone. Is he giving us any indication that there will be some type of easing? How does he feel about all of this soft data that we're getting, consumer sentiment? And more importantly, we're getting an SEP and a dot plot today. Where does he see inflation expectations? So where are expectations from the Fed, the entire committee? And how that's going to pan out. I think that's more important than anything.
And one question that I have that I'm going to be posing to our guests throughout the show is whether, if they do have a dovish tone and then the market responds, moving to the upside, does that impact policy from the White House? Do we see this kind of domino effect where then the White House feels they have more free reign on tariff policy and then that impacts the economy negatively and then the Fed has to cut? Like, how does it all interplay?
It always interplays. And I think it's so interesting because the ECB did cut rates and they were mentioning uncertainty. Even in earnings calls, everyone is uncertainty with trade policy. So even though the stock market definitely moves on earnings, then we see the impact of the Fed funds rate on consumer behavior and borrowing, subsequently the yield curve, and then that going into models that tell us earning expectations, and then we'll adjust PE ratios even further. So that's the domino effect that I will see, and any softness is that effect that it will have on the yield curve, actually.
Yeah. And really quickly, before we move to our guests, how are you thinking about recession risk right now?
Right now, I think they're on watch because of the layoffs that were mentioned today, but I think it's soft data versus hard data. And the soft data is saying that everyone feels that there might be a recession. We have inflation expectations. It's almost going viral now that we've got this increased retail participation. People get very hyped up on social media, and I think that's playing into even retail participation started since COVID. So this might even be this new generation's first experience with a correction, mean those recession fears are elevated just from a market participant's perspective. Personally, I think I need to see hard data, but I'm also worried about how the Fed sees that soft data. Soft and hard data is really the theme for me right now.
All right, Jessica, really great breakdown. Thank you so much for that. We're going to turn now to that Fed decision out at 2 p.m. Eastern today. Here on What to Expect, our Fed correspondent, Jennifer Schomburger. Hey, Jennifer.
Good morning, Maddie. The Federal Reserve widely expected to hold its benchmark interest rate steady in the range of 4.25% to 4.5% this afternoon when it concludes its two-day policy meeting. It is also expected to retain the outlook for 2 interest rate cuts at some point this year amid the uncertainty of President Trump's policies on the economy. The key theme out of the meeting this afternoon is expected to be uncertainty. Fed Chair Jay Powell is likely to reiterate that the Fed is not in a hurry to cut interest rates as it awaits clarity on the administration's policies and their impact on the economy. The Fed chair is likely to emphasize that officials' interest rate projections are highly uncertain given upcoming changes with tariffs. Investors are also watching for whether Fed officials now see inflation staying higher this year than previously estimated, and whether economic growth will be revised lower as officials begin to factor in the impact of Trump's policies. And while many Fed watchers expect the Fed to lower its growth forecast, Chair Powell is unlikely to give any signal that a recession is impending, though the bond market is signaling that the odds of a recession are rising now as uncertainty clouds business investment and hiring as executives wait to see what tariffs will look like. One of the biggest questions on the table right now is how the Fed will navigate the potential for higher inflation and lower growth, and whether that amounts to a stagflation scenario. One other thing to watch this afternoon is whether the Fed hints at any pause on its balance sheet drawdown in the face of hitting the debt ceiling soon, and whether that could cause complications for money market funds or the Treasury market. All of this decision coming down at 2 p.m. Eastern this afternoon, followed by Fed Chair Powell's press conference, she tried to say, at 2:30 p.m. Maddie?
You always crush it, Jennifer. Thank you so much for joining us. Really appreciate it. Well, a cloud of uncertainty looming over the Fed as the impact of President Donald Trump's policies on inflationary pressure and economic growth still a concern. The FOMC expected to hold rates steady, so the focus for investors will be on Fed Chair Jay Powell's commentary and what that can mean for the $29 trillion Treasury market after its recent rally. Joining me now with more, Vincent Reinhardt, Chief Economist at BMY Investments. We also have Brian Rilling. He is the Global Fixed Income Strategy Head over at Wells Fargo, and Jessica Inskip still with me here. So Brian, let me start with you. Government debt has returned 2.4% this year. I don't have to tell you the S&P is down in the same window. What does Powell have to say to hit the right notes to not disrupt the return investors have been able to get from that government debt?
Well, I mean, the return from the government debt obviously is because rates have been moving lower on the stock sell-off. So if Powell came out and said something that was very dovish, That's going to excite equity markets, not so exciting for bond markets. I don't think that's the case, by the way. I expect the Fed to be quite cautious in their outlook, really favoring more on the side of making sure inflation doesn't start to go back up. I think that has to be their primary concern here. Obviously, watching that employment situation, but it would take something like that, in my mind, for to see that sell-off in the bond market.
Yeah, and Vincent, come into the conversation, because if the Fed is going to continue to be cautious, at what point does this soft data, do the negative vibes, the pessimism about the economy, force the Fed to have to do something?
So I think cautious is the polite word. The word I'd use is confusing. And the reason is exactly what you two have been talking about. We're getting information on soft data. We're getting information on hard data. Some of it is talk, a recession vibe we just heard about. And the fact is, the Federal Open Market Committee is a diverse group of people. Some of them will be more traditional, bound by the hard data, slow to move their forecast. They're the ones who want to be leaning into inflation because of concerns on tariffs. And some of them, probably Chair Powell, will be a little more in touch with the soft data and more willing to change their forecast. So I think we're going to get a situation in which what the committee writes down is mostly hawkish sounding, no more larger cuts on net. And Chair Powell will be a somewhat poor spokesperson for that view. He'll come across as a little bit dovish. So 3:30, we're all going to be scratching our heads.
I think that's so interesting, Vincent, if I may. I know on the speech that he was talking about on the Boston Economic Forum, there was a question asked about non-traditional data, and he gave us an insight that he's looking beyond the data that we see from the government agencies, as far as maybe hard data from credit cards or showing some resilience there. Do you think that he'll maybe speak to that, or there'll be any impact?
So I think the important point is Chair Powell is more eclectic. He's not a model-based policymaker. And if you're model-based, you tend to look at the hard data that get reported on a fixed calendar. He brings into account more information. Problem is that information is harder to explain and harder to put into a tidy package. So I think that there's a sense that spending is fraying at the margins, that the labor market is cooling at the margins. Chair Powell's probably going to be more sensitive to that than a lot of his colleagues.
That makes perfect sense. Brian, my question for you, you mentioned uncertainty reigns within your notes. And I love that word because I really think that's the theme for the market. And my question really is resilience and risk. Since COVID, even since the great financial crisis, I've noticed that a lot of companies are just more agile. They're hoarding labor. Maybe they're hoarding inventory because of tariffs. Maybe even the retail clients are doing that. Do you think maybe that could play into why we've seen this engineered, I don't want to say soft landing, but the landing scenario that we're in right now?
Yeah, I mean, the market's been resilient. The economy's been resilient for years here, really defying expectations, quite frankly. If you recall back, we had a quite inverted yield curve. Most people expecting much more of a slowdown than we saw. And a lot of that is to the labor market dislocations back from COVID. I think we've had some healing in that. A little bit more in balance, and so you're seeing what now is again I would characterize as a soft patch. You're starting to see a little bit of softness in the labor markets, but nothing that's overly concerning. And again, I think this soft patch is just around the uncertainty. I do expect that in the second half of the year, we'll see a reacceleration in the economy. And quite frankly, I think we'll see a reacceleration in inflation as well. So I think the Fed has to be fairly cautious here, to see, you just don't want to make a mistake here where you cut too much and then all of a sudden you're fighting, that inflation devil, which is, of course, something that they had to do in the 80s, had to fight it a second time. You definitely want to avoid that.
And Brian, I just want to end by switching gears a bit and getting a sense from you what we're seeing in terms of global demand for U.S. Treasuries. What is that looking like right now? Is it signaling to you that there's still faith in the U.S. economy, despite the fact that we have this deficit, that we have obviously a lot of uncertainty in the room, to your point?
Yeah, I mean, listen, we're not alone in our debt and deficit problems. The rest of the developed world is in a similar, if not worse, shape. So you are seeing a little bit resurgence in Europe. Europe willing to spend again, which is, again, something we haven't seen in a while. But yes, I do believe that the U.S. economy kind of remains at the top of the list or the top of the order in the world in terms of being kind of the best and the brightest right now.
All right, at least a little bit of optimism for us to end with, Vincent. Thank you so much for joining us. And Brian, thank you as well for joining the conversation. We appreciate you. All right, coming up, we're going to take a look at more trending tickers this morning, including a word of warning for Chinese markets. That's coming up next on Catalyst. It's now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the day with Yahoo Finance's trending tickers page. First up, Chinese gaming giant Tencent posting a fourth quarter earnings beat on the top and bottom lines. The company's seen a 90% increase in profit from the same period in 2023. In addition to gaming, Tencent has expanded into artificial intelligence, releasing its latest model on Tuesday. The company reporting AI cloud revenue doubled for the year, but you've still got the ADRs here moving to the downside just a bit. I think it's really interesting, Jessica, in the context of what we've seen just in terms of the run-up in China and specifically Chinese tech. We had BYD announcing that 5-minute EV charging yesterday. We saw that putting pressure on Tesla. Obviously, the DeepSeek news putting pressure on a lot of the AI names. So I've been wondering, are we entering into a period of AI dominance from China? But then Bank of America throwing some cold water on that idea this morning. What are you looking at in the China trade?
So I think it's really interesting and almost reminiscent of 2022 in our markets when things switched over and AI started dominating the narrative and held up the S&P 500, which means it could perhaps even be something narrow. It might be the other securities that aren't going to do so well. But it's so reminiscent as the fact as they announced some buybacks, their advertising has done well, but they're ramping up spending on chips and servers. It's almost like they're pulling from our playbook, which is great. We've got something to go off of and we can understand what's going to happen. But if everything is this multiple expansion, the follow through from that is earnings follow through. So now we have to see earnings follow through. This is a great beat. I want to see that consistently. And if there is still earnings follow through, and what I think we're missing and what Wall Street, even coming back to the US and bringing it to this competition we have within AI, we are focused on that chips factor. NVIDIA yesterday told us about the software layer and inference and how it's really an AI ecosystem. So what we've learned is even though these big dominant players have a lot of spending, are doing well in AI, they're using AI to make more AI, to make more AI. And it's compounding, leading to consistently beating earnings. And perhaps it's just not understood. And therefore, earnings expectations keep getting revised because of the uncertainty around AI.
Right, and a lot of efficiencies from that AI. I did think it was interesting quickly in this Bank of America note where they do call for a correction in China stocks here. They cite their trip to Shanghai, saying loan-only investors on the mainland are getting nervous, worrying about a lack of improvement in jobs, deflation and credit demand, and the impact of geopolitical tensions they call overlooked. So I thought that was really interesting. They're calling for some similarities in some of the bubbles that we've seen here in the United States. I wonder to what extent, though, if we take your point, are we just going to see what happened in 2022 where there was that sell-off and now we've seen tech names completely recover since then?
Absolutely. They recovered very well, but they also held up the market for a brief moment and perhaps even stopped our markets from going into full bear market territory. There was literally the Magnificent Seven was holding up the stock market from an earnings perspective quarter over quarter, and it didn't take until really the 2024 last year until it broadened out inclusive from an earnings perspective.
Yeah. All right, Jessica, we're going to continue talking tech today, but we do want to switch over to financials. Morgan Stanley planning about 2,000 job cuts to trim costs. According to reports, the reduction in staff will not impact financial advisors. The cuts were also planned before the recent market correction. The financial sector has been one of the hardest hit by the recent selling action. We saw a huge run-up in financials after the election of President Trump. A lot of euphoria about what was going to happen in terms of banking, deregulation, and now you've seen financials under a bit of pressure here. And then you have these job cuts. Jessica, I'm curious how you are looking at what's coming next for financials given the policy uncertainty.
Well, one, I am really concerned with how this looks at the broader picture. I'm still very positive on that AI narrative. However, financials is what really led up at the beginning of the year. And post-election, it was really, really great. The same thing with technology was what led us up before and then also led the decline. And this looks like it might be happening with financials as well. So it needs policy certainty. We were promised this pro-business and less regulation that seemed to benefit these financials. What I'm worried about is if this spurs any type of larger trend. Any mass layoffs is absolutely a concern. And if there were hoarding of jobs and now we're cutting and getting into labor trimming, that's a very cause for concern if that has any bleed elsewhere.
I thought it was really interesting too, and I was just looking this up off the back of news about JP Morgan's traders scoring huge gains on the market amid the downturn that we've seen this year. That's something that's going to show up in their earnings, I imagine, right? If they are having so much success beating the market, I believe they're up double digits on the year. Meantime, the broader market is down nearly 10% on the year at the moment. So what does that look like in their earnings moving forward? Is that a good catalyst for financials?
Well, and we want to know why the earnings are doing so well. Is it because of the cost cutting that's happening on the bottom line? Are they increasing revenue? There's a lot of more increase in fixed income that helps with their margins because of the spreads that they can capture. Right. So I really think financials have a lot of positive catalysts that go for them, but I think what the market really cared about was that pro-business and administration, and so clarity on that will help, but I am worried about the cost cutting and how that would bleed elsewhere. That's a concern.
And we have a former FTC commissioner on our show later who will be able to ask about that
so excited
as well. It's going to be a great conversation. Yeah. But as we head to break, let's get a check-in on shares of Boeing here. Boeing rising this morning up over 6.5% after CFO Brian West told investors the company is off to a good start in 2025, saying cash burn is easing. That optimism coming after an embattled 2024, starting with that mid-flight Alaska air door blowing out. That triggered a review of Boeing's manufacturing practices and also broader concerns just about the company's health, whether or not there were concerns about people who are working on the planes being able to speak out about any intricacies that they saw and problems that they saw with that manufacturing. The new CEO, Kelly Ortberg, is making that a key focus. You can see those shares up nearly 7%. We'll be back with more on Catalyst. Russia and Ukraine exchanged air attacks against one another overnight on Wednesday. The strikes came hours after Russian President Vladimir Putin agreed to a temporary pause on energy infrastructure strikes during a call with President Trump. Ukraine President Zelensky saying Wednesday that Putin's words are, quote, at odds with reality, adding he plans to speak with President Trump later this week. Joining me now, we have Ian Bremmer. He is Eurasia Group's founder and president. Ian, great to have you on here. I just want you to explain to us, how could this war actually end with Trump as president? What is the outlook?
I think a ceasefire, an actual ceasefire, is plausible over the coming months, but clearly the United States is prepared to accept much harsher outcomes than the Ukrainians at this point, and they're negotiating directly with the Russians over the heads of the Ukrainians and the Europeans, so that's problematic for them. The issue is the Ukrainians don't have much leverage, and it's not going to be easy for them to continue to fight, even if they want to. I mean, I would say that their ability just to maintain troop levels to ensure that they can keep more or less the present lines of combat probably doesn't last past summer. So one way or the other, the Ukrainians need to get to a ceasefire. But that doesn't end the war. And your question to me wasn't about a ceasefire, it was how do we end the war? Yeah. How do we bring actual long-standing sustainable peace between Russia and Ukraine, between Russia and NATO? And there I don't see an answer. There what I see is the Americans trying to engage with Putin and have a rapprochement that frankly is not likely to be accepted by the Europeans and is not likely to be accepted by the Ukrainians either. And that's the big change, of course, that's happening here.
And talk to me about how that impacts, obviously, the United States' relationship with Europe. We've seen, for example, this big run-up in European defense stocks on this idea that Europe's going to have to increase defense spending because the U.S. is backing down on their defense spending with the likes of Ukraine. Where do you see the U.S.-Europe relationship heading off the back of the Russia-Ukraine war?
I would say that the U.S.-Europe relationship is the one that has probably been permanently damaged by the events we've seen in the last 2 months. I wouldn't say that about the U.S. relations with the Middle East or with Canada or with Mexico or with the Asian allies, but I would with Europe because they're facing 3 different challenges from the Trump administration. The first, which everyone is facing, is the issue of higher tariffs and a more challenging trade environment and a sharper level of U.S. industrial policy as opposed to promotion of free trade. Secondly, the Americans are actively coordinating and trying to build a relationship with Europe's principal enemy, Putin's Russia, and they're not coordinating in any way those discussions with European allies. And then third, at the same time, the United States is saying that they consider that the European leaders, many of them, are actually the principal security threat to the relationship, not Russia, not China, not Iran, but rather this, as Trump calls it, wokeism, the liberal mind violence, the opposition to free speech, and the willingness of Trump and Elon Musk and J.D. Vance to promote Eurosceptic forces inside the EU, including the AfD in Germany, which is widely considered in Germany to be a neo-Nazi party. So, I mean, when you put those 3 things together, and no other countries in the world are facing that constellation of direct threats to their own ability to maintain their system of governance as the Europeans are, you understand why this feels urgent and why it feels existential. And that helps to explain the sudden, pretty dramatic steps that European leaders are taking, which is also being felt in the markets, as you mentioned.
Yeah, my question for you is, right now we're dealing with this uncertainty that's happening with tariffs, and during Trump's first term, it caused a lot of volatility in the market. And it seems like perhaps because we're in that current chapter, the volatility is ever increasing today because of that. Do you think because of this bad situation that you so beautifully laid out with our relationships with Europe, that there could be even more uncertainty, retaliatory tariffs that are going to put us in more of a volatile situation that could impact our markets?
Sure. I think that some of the purpose of tariffs this time around is more structural. It's really to change trade flows. It's to get manufacturing in the United States. That will take a long time to bring about. So it's not just about trying to get the Europeans and other countries to react in ways the Americans want. It's an unwillingness to accept a free trade order. It's a belief that free trade order benefited some shareholders in the United States, benefited some corporations and banks in the United States, but didn't benefit the middle class or the working class, and they want to turn that around. Now, that's one problem the Europeans have, the fact that Trump isn't going to be constrained by his own economic advisors or by the markets the way that he was during his first term. His team is much more loyal. He's not running again for office. He was almost assassinated, shot in the head a few months ago, and is utterly convinced that he's right on this stuff. So he's more willing to, if you will, soldier through a level of economic pain. And you've already seen that in the way he's talked about a potential recession and the way he's talked about, globalists being concerned about markets. Those are his enemies. Those are enemies of the people, that kind of thing. But the Europeans aren't just dealing with that uncertainty. They're also dealing with needing to spend far more money on defense. They're dealing with the fact that their energy costs are dramatically higher than those of the United States, and they're going to continue to be, at least for the coming year. And of course, they've got massive productivity challenges. They don't have the big tech giants that the United States or the Chinese have. Now, they do have a social contract that, sort of takes more care of the average citizen and is expensive. But unfortunately, that system of governance that is more aligned with the average citizen has not led to growth and efficiency.
Right.
And so the Europeans are kind of stuck without a model going forward, and that's a real problem for them.
Ian, 30 seconds left. Given all of that, are you concerned we're heading toward a recession in the U.S.?
Not particularly, but I do think that there's a far higher chance of a recession than there was a few months ago, and it will be almost purely self-imposed if that's the case. I think that what we're going to see is a massive amount of uncertainty, almost all of which is being driven by the United States. Usually geopolitical uncertainty and market uncertainty is driven by other countries.
Right.
This time around, it's not.
Right, and the question, of course, is it necessary? Yeah. Ian, thank you so much for joining us. Really appreciate it.
Sure.
Coming up, antitrust enforcement under the Trump administration. What changes at the FTC could mean for deal making this year? That's next on Catalysts. A shakeup at the Federal Trade Commission, President Trump firing the 2 Democratic commissioners. This is just the latest move drawing criticism about Trump's executive authority. Here now with more, we got Mozelle Thompson, former FTC commissioner. Mozelle, great to have you to break down this move for us. So Trump firing 2 Democrats on the FTC. What does that tell you about what antitrust enforcement is going to look like moving forward under the Trump administration?
Well, one of the questions has always been is whether there's going to be some uncertainty or not. And this definitely injects uncertainty in there. You know, the FTC has been around for a long time, since 1914. And the FTC Act creates commissioners who serve in 7-year terms in a staggered basis, and that no more than 3 can be of one party. So this has been operating ever since 1914. And that there was a test about the principles and who can hire and fire directly by the Supreme Court in 1935, when FDR didn't like one of the commissioners of the opposing party and he wanted to fire him. And the Supreme Court ruled that absent inefficiency, abuse of office, or neglect, you can't fire him, in part because the FTC is not just, the commissioners don't all just serve in a policy role, they serve in a judicial manner. They sit as judges. And so that is so now the 2 commissioners who were fired are going to challenge the firing in court. In the meantime, there are 2 Republican commissioners who are sitting, and one more vacant seat, which has yet to be for a Republican, that has not been confirmed yet. So the question is, how will the FTC be able to act? They will not have enough commissioners there, and there'll be some question as to under what authority and what legitimacy.
So it sounds like there's the potential for quite the slowdown in deal making, at least in terms of approvals, if the picture you just painted did come to fruition. I'm curious about your broader outlook, though, for deal making under this administration. There was a lot of euphoria after the election about M&A under Trump and deregulation. And then we had news that the administration was actually going to be mirroring Biden-era regulatory practices. Where's your head at when it comes to what deal making is going to look like under Trump 2.0?
Well, I did notice that they've kept the merger guidelines, and so it looks like they're going through enforcement and they're continuing their enforcement action. But the devil's in the details. In other words, what are the possible off-ramps, the possible settlements for some of these cases? And what it appears to be is with the additional executive order that took place in February, where the president wants to take a higher control of independent agencies like the FTC, it looks like he's going to want to be the one who cuts deals for companies if they're under the scrutiny of the FTC, which in and of itself is unprecedented.
Unprecedented is such that can be an exciting word and a scary word at the same time. And so it's something I definitely want to focus on. Uncertainty is definitely the theme that we've noticed today and within the markets. And I can see that within what's happening within the FTC and the regulatory environment. Do you think that there'll still be some checks and balances because there is an adoption of that previous policy. But if there is this thought of perhaps deal making on a higher level on the executive branch, what's the path forward there?
Well, I am not sure what the end game is here. Because of the ability to get a majority for your party on the commission when you come into office, that he was going to have a clear majority, President Trump, anyway. So by firing the two Democrats, I'm wondering, what is it that he's trying to avoid? He's going to get what he wants. Is it because he wants to avoid scrutiny or questioning? That is a bigger challenge. So that's going to definitely go up the courts. And in the meantime, what the market is going to see is this level of investigation, whether it comes to fruition into actual enforcement action or not. We'll have to see. And we're going to have to see that if there comes a point when people want to settle some of these cases, including some of the big tech cases, what that's going to look like, who's going to be involved.
All right, Mazel, we got to leave it there. Thank you so much for joining us.
Thank you very much.
Well, Discord is changing the gaming industry, connecting more than 200 million monthly active users. Our own Brad Smith sitting down with the CEO to discuss the company's growth.
Discord started as a place to talk and hang out with your friends around playing games. And there were a few years during COVID when Discord really opened up and began to be used for lots and lots of different things. And we really tried to meet people where they were and service, and build and innovate for folks. It was a very, very, crazy time for all of us. But now over the last couple of years, while people continue to use Discord for all sorts of things, we do find that most people spend most of their time, in friend groups playing games with their friends, and hanging out around those games. So we've really focused back on kind of our core customer base and innovate for them and for the industry side of it. So it's not so much a pivot, it's more of like a homecoming.
A few years ago, people were lighting up the Yahoo Finance platform and looking at the ticker symbol Microsoft because there was so much of the deal talks that was swirling around Microsoft and Discord, a $10 billion figure that was out there and knocking around. Do you ever think back on some of those deal talks with Microsoft? What did you learn about your product, your team, the market opportunity as well that you see for the brand and the business going forward?
Yeah, we really appreciate the love that we hear from so many people as they speculate and talk about these kind of things. But for us, really, we're just focused on creating an amazing product for people who want to talk and hang out with their friends, and building a great company, and now really trying to help the developers in the industry side, bring their games to life. So I think the biggest learning over the last couple of years for us has really just been how focus can really yield a lot of creative results. And great new products that we get to use for ourselves and for our customers.
Well, so thinking about the past and also thinking about the future here, too. I mean, your company is one of the most talked about and hotly anticipated 2025 potential IPOs. In recent weeks, you have rumors and reports swirling about the company working with underwriters and bankers. We have to know, is there truth to the rumors, to the reports? Is Discord preparing to go public?
Well, I can't comment on any speculation, but we're very focused on building an amazing product, an amazing service, an amazing company, and that's what gets us up out of bed every day, just thinking how we can innovate on behalf of our players and create new cool ways for them to talk and hang out with their friends.
I imagine there are much more core business projects that you would like to get everyone's attention back to, but if you were to go public, even in an environment like this, how soon would you like to get that done, get that dusted, and be able to focus the team corely back on what you do best?
Well, we are very focused on what we do best, which is building our service. And that's really the thing that we do every day. On the journey of any company that has raised venture capital and has shareholders, obviously, these kinds of things are talked about and potentially in the future, but we're very focused on just making an amazing product and showing up every day to help people talk and hang out with their friends.
And Brad Smith joins me now for more. Brad, obviously great questions to the Discord CEO. What else stood out to you in the conversation?
That was just a snippet of our conversation. We got to speak for 15 minutes, and I appreciate the time with Jason Citron, who's the co-founder and CEO of Discord. And to really quote, or at least kind of borrow this from, one of my favorite quarterbacks, Philadelphia Eagles quarterback Jalen Hurts. He's keeping the main thing for his team right now. Of course, there's these IPO rumors that are swirling, and the company is doing financially great right now. As I had asked him a question a little bit later on in the conversation, he said that in response to my ask about the financials and whether they needed more capital, that they're doing just fine. And so you think about how healthy the company is and steady going into a potential IPO. It sounds like the business itself is ready. Now it's just about making sure that as you are continuing to build on the service, that you're having all of these different checkpoints that the market would be asking about on a more cadenced level going forward from here, that you're continuing to keep that the main prioritization. And there are a few data points to really pick apart with regard to that. Number one, the 200 million monthly active users. Anytime you have a company that's in this landscape go public, typically it's asked of them on a more cadenced basis, okay, what's going on with the monthly active users? How are you extracting even more value from them? And this is where it comes back to my second point here, this Nitro paid subscriber. And that's going to be amazingly important because that's where they're layering on even more of that value add and the value creation for the users that are on the platform. This is very much a platform that's built by gamers for gamers. And as we think about where they're taking that element to, this is where it gets into the announcement that they put out there just earlier this week in the rollout of their social software developer kit, that SDK, and making sure that they can take that experience to other realms where other developers can use some of the tools that Discord has already built up so aptly and infuse that into other gaming experiences, as well here. And if Discord has its way, I think we could have a new fan favorite mascot that makes its way into the public markets at some point, and that is Wumpus. Move over Snoo, move over Ghostface Chilla at Snapchat.
There it is.
Wumpus could be the new thing that we're talking about here.
Thank you for telling me the name, because I was worried that you were going to ask me and I wasn't going to have it. Brad,
Big
thank you so
Wumpus
much.
energy,
Wumpus,
yes.
appreciate it. Thank you so much, Brad, as always, for bringing us the great interview. Coming up, why ETF investors are looking for more closely managed options. That's next on Catalyst. Actively managed ETFs approaching $1 trillion in assets under management. Our next guest saying investors increasingly turning to actively managed products to navigate the uncertainty in the market. Todd Rosenbluth, TMX VettaFi Head of Research, is here for this week's ETF report brought to you by Invesco QQQ. Todd, great to have you on. I just want to get a sense of what the demand for actively managed ETFs is signaling to you about the market right now and some of the uncertainty that we're seeing.
So you're right. We're approaching $1 trillion in overall U.S. listed assets in actively managed ETFs. We've seen active ETFs punching above their weight. They're roughly 9% of the overall ETF pie. They were well above that in 2023 and 2024. They're close to 30% of the flows this year. And what we're seeing is that advisors and investors are turning to active ETFs to both get targeted exposure at the theme and the industry level, as well as broad market exposure. So at the Exchange Conference coming up this weekend, we're going to be talking with some of the active managers from Cohen & Steers and TCW. They're on the more narrowly focused of those actively managed thematic-oriented ETFs. We have Sprott that entered the market with an active gold and silver miners ETF. And then the flows are really going into those broader strategies. So JP Morgan's JEPI and JEPQ have seen strong inflows. We've seen Capital Group have some success with their dividend value ETF. There's a lot of interest in actively managed ETFs.
So Todd, what is the first step for investors who have been just enjoying the returns, the double-digit returns of the broader markets over the past couple of years and want to get into actively managed ETFs? What's the first step that they should be taking in their education process before getting in?
So the folks that are mostly interested in actively managed ETFs have been fans of active management for years. So they've long invested in actively managed mutual funds. That's how most of the money in mutual funds is managed. Many folks have moved into the ETF space with lower cost index-based products. Now, some of the firms that they've known for years in the active world are here within the ETF world. So I mentioned a couple of those firms. I'll just expand on a couple others. T. Rowe Price and Fidelity have built out a strong lineup. What you want to do is look at who's running the fund, look at the track record of the fund, either the actual ETF that's trading, or take a look at if that same manager is running a mutual fund that may be similar but not exactly the same thing, and then look inside the portfolio. You should see some names that you would expect within the portfolio, but perhaps some names that you might not necessarily expect, that you could benefit from that fundamental analysis that the team is bringing to bear. So if it looks too much like an index, then it's too much like an index, and you want the benefits of that active management.
I find that so interesting, Todd, and I want to focus on the specific type of products. And I think there's a lot we can understand from the investor of where the flows are coming from. For example, I know a lot of those leveraged products that have been day traded might be misunderstood from an education perspective. So that would tell me if there's a lot of flows there, that might be a risk-on type of mentality or that trading type of mentality. Whereas on the other hand, I noticed you mentioned a lot of the active income ETFs, perhaps using option strategies, which give me an indicative of a different type of trader that's more long-term and income-oriented. Do you have any insight onto the flows there or information that retail investors could utilize?
Yeah, so the risk on leverage products, Direxion is one of the leaders within that space. They and ProShares have a long history of offering products, and they continue to build out that lineup of leverage products, either single security or industry-oriented products. Whereas we're seeing more of the risk off. Firms like Calamos and Innovator are a couple of the firms that are newer to offering ETFs that are using options to protect the downside of a portfolio. And then you mentioned income. So JP Morgan's products are the largest within that space, but we have firms like Neos that is a specialist within the options-based ETF world that offers products like SPYI that offers extra income tied to the S&P 500. So there's lots of different ways to be able to add risk if you're comfortable with that, or to protect the downside and generate additional income using ETFs.
All right, Todd, we got to leave it there. Thank you so much for joining us this morning.
Thank you.
4 times a year, the market experiences triple witching. That's the simultaneous expiration of stock options, index futures, and index futures options. Jessica is here with us with more. Jessica, I know you are an expert at all things options. What can you tell us about what occurs around the markets at triple witching time? So it's like our accelerated options expiration because we simply have more options expiring on one day. And we even think about, I want to look at positioning post today because zero DTE options, so days until expiration options, are actually heightened on big economic days, which is today, which means positioning is going to adjust, and then we're going to look at that on Friday. Essentially, what can happen where you have to know when a position is created, another one is, and then market makers keep what's called a delta neutral portfolio. So without using all those big words that I did, we look at the market really from a two-dimensional perspective, up and down. Options are giving us a path because we have a price, which is a destination, and we have a time frame. So what I will do today after the Fed announcement is we know the path, the time frame is Friday, the price, where is all the activity in open interest, and then there will be an unwind on Friday, which will basically pin us to a price. We played the game on my active trading desk days where we'd say call the close on those days to see who can do their math the best. Oh, fun. I love that. We'll have to bring you back to do that with us live, Jessica. That would be fun. Thank you so much for joining us this hour. It was great to work with you. I really
My
appreciate it.
pleasure.
Hope to have you back soon. And thank you all for listening. Coming up, we've got Wealth dedicated to all your personal finance needs. Stick around.